Hey everyone, this is Elijah K. Johnson with Liberty and Finance. Crazy day today in the markets. We're here with Steve Penny and Robert Kientz on this live stream. Thank you everyone for joining us today. And Robert and Steve, thank you so much for coming on.
You bet, Elijah. Thanks so much for inviting me.
Yeah, thank you for having me, Elijah.
Fantastic. Now, Robert Kientz is from Gold Silver Pros, Steve Penny from the Silver Chartist. Now, I'd like to start with Steve, just kind of getting your reaction to what we saw. Silver under $23. We haven't seen this for a while.
Yeah, for sure. We've kind of been expecting this. A pullback towards $22 is not surprising at all. There's the lower rail of like a 1 year slightly upsloping channel, and we pulled back to within a whisker of that support today. So as long as we hold here, there's really nothing too concerning. However, if $22 does give way, that could open up the door to a little bit more downside in silver. And I think what's driving this is obviously anything that's perceived as good economic data. The general market participants are looking for, more taper talk coming from the Fed. And as long as that persists, that narrative, I think there might be a little bit of pressure on the metals, but we don't expect that to last long at all.
And Robert, in your view, what do you think is causing this pullback?
I just look at the futures activity trading because that's pretty much what drives the price in the metals is the futures trading. There has been a lot more downward pressure on both gold and silver price this week. The settlements have closed lower and lower, and the price mirrors that. So it's more traders believing either the price is going to go down or taking downside protection to protect their interest in the market, like the producers. I'll take a deeper dive at the COT report once it comes out. That tends to lag the futures data by about a week from the CFTC. So we'll look at it and see who's positioning what. One of the things I pointed out last week, I was doing an investor conference, and I pointed out that it looks like there's a consolidation towards the mean or towards a net zero position in both the gold and silver market in terms of short and long derivatives. We'll see next week if that trend is continuing. But it looked to me as if people were preparing for some sort of price move. Maybe it was the downward move. I think maybe they're preparing for a bigger upside move, maybe in the future, because the rest of the commodities complex is really hot right now. There's no reason for gold and silver not to be when you have uranium touching on $50 yesterday after being stuck in the $20 range for years and years. You've had copper, lead, zinc, all doing very well. So eventually you have to think the precious metals are going to catch a bit, but we may need some pretty serious, negative economic news for that to happen.
One of the things that is counterintuitive is as we see the price fall here, as a Miles Franklin broker selling precious metals, we've just seen a flood of calls today, right? And we've seen, at least on my end, I don't think we've seen any selling. And it seems like when the price falls, that's what you'd expect, right? Is people selling, but that's not what we're seeing. I guess if Steve, would you like to jump in here, kind of your perspective on that? Why in at least the retail realm, we're not really seeing any selling, and it's just people trying to buy the dip.
Yeah, that's what makes the silver market so unique. I don't think there's any other commodity market on the planet that works like this, where there's an increase in demand for physical product and no increase in supply, yet the price goes down. So the silver market is the only market on the planet that I can think of where that happens. And that's because the price is set on the COMEX based on supply demand of paper contracts, not necessarily physical metal. So eventually that paradigm will end. But unfortunately, that's the way it is right now. And, the price is set on the futures market. So that's not surprising at all.
And another counterintuitive thing that's happening right now is with the dollar index as well. And we were just talking about this before we started the live stream. Robert, if you'd like to share what the dollar is doing right now.
Yeah, so we've seen strength in the dollar index. Now, the dollar index is the dollar against a basket of other currencies. So it's not the value of the dollar over time in terms of inflation or ability to purchase, but it is compared with, the other basket of currencies around the world. And it has risen it's risen long-term trend channel since June, but since the beginning of September, about September 5th or 6th, the last 10 days, it's risen pretty strongly, touched on 92. Now it's trading up around 92.92. So short term, when the dollar rises, gold tends to fall a little bit. That trend does not occur long term. It occurs short term. Long term, that trend dissipates. So, but whenever you see the dollar strengthening a little bit, you'll see people going short on gold. And I think when you combine that with unemployment, I wanted to talk about that for a moment. The unemployment numbers came out September 3rd from the BLS. We had 235,000 jobs created, so dropped us down to about 5.2% U6 unemployment. Now, the overall labor force participation rate has not really changed since 2008 when we had the last crash. It's still sitting around 62, 63%. But the short-term unemployment picture has gotten better. And I think that's encouraging some traders in the market to say, we're not in a crisis stage. We don't necessarily need to go long gold and silver. And I think that's reflected in the futures trade.
One of the things, yeah, that is interesting is how much it's set by the futures market. And it doesn't seem like there's, what is your perspective, Steve? Does it seem like there's anything on a macro level that could be driving the price down right now?
Of the metals or the dollar?
Of the metals.
No, I just think it's the market, general market participants are expecting a taper. And now whether that actually happens remains to be seen. I mean, I'm highly skeptical if they're actually going to do that. But, as long as the market is expecting the easy money to kind of, the trend towards more easy money to slow down, that's why there's pressure on the metals right now. And, why the dollar is seeing some strength. And speaking of the dollar, so much of these markets are driven by just algorithms these days. And whenever price is trading above a rising 50 and 200-day moving average within a bullish technical construct, these algorithms are programmed to buy the dip. And that's the way the dollar is structured right now. And there is potentially a little bit more upside before we run into some significant resistance on the dollar.
Now, if we do see this upside in the dollar, right? Do you see, Robert, do you see that gold and silver could fall lower from here?
Gold and silver could always fall lower due to the paper trade. I think Steve is correct. That's, in the short term, that's the way the markets are traded. It's traded, the paper trade, the derivative trade. The way the markets were set up is supposed to be for legitimate hedging, but the legitimate hedges are only a very small portion of the market. Mostly it's a gambling market. And people gamble on the price very short term, may trade in and out of a contract 10 times a day. I have traders tell me all the time, I take a position 10 times a day. So they're looking for micro movements in the price to take advantage of. So this has nothing to do with the actual supply and demand of gold and silver for industry or for investment purposes. It really has to do with how traders are seeing on a very short-term basis the factors that may drive gold up or down. And in fact, if you get large players in the market, they can help drive gold up or down, for example, to meet a specific options price that they want to meet. So you can actually use the futures price to push gold and silver up and down to benefit yourself in other markets. And some of that does occur as well. And that happens in every market. It's not just gold and silver. It's all of the commodities.
And if we could turn to Steve now to kind of give us the technical picture with the charts, where do gold and silver stand right now?
Okay, yeah. So this is a daily chart for silver going back a year. And you can see these big, thick green lines here. And this is just an obvious channel that silver has been trading in for about a year now. And we've come down and tested the lower boundary of this channel 3 times now. And we came within, a few pennies of that this morning. Now, this is the support you really want to see hold. If this support fails, those algorithms are going to see a window down towards maybe $19 silver. Now, it remains to be seen whether this support holds or not. I tend to be optimistic, and I think it will. But no one knows. We deal in probabilities, not predictions. So I think the probability is that support holds. But if it fails, we should be mentally prepared for a pullback towards $19 silver.
Mm-hmm.
What is your perspective, Robert? Do you think that $19 silver is realistic to see?
Yeah, I charted the same $22-ish support line, longer term trend line that Steve has charted here. But I agree with you. It could pull back to 19. And again, remember, it has nothing to do with the physical trade. It has to do with the short-term view on short and silver according to a technical chart. So he's done a very good job here of showing, and you see that lighter green line he's got there on the screen. That's where you get down to the $19, I think, or yeah, and that's perfect. And that's what traders look at every day when they're looking at the derivative market. So the thing is, what's going to be the catalyst for silver and gold to go back up? It's going to go back to, are we having economic problems? Are we having bank failures? Is Evergrande going to be an issue? Is China going to be an issue? Are we going to have economic slowdowns? Are we going to have inflation? We are seeing some inflation. We're seeing shortages of goods. We're seeing high shipping container prices. We're seeing some signs of stress in the economy, but it hasn't gotten to the point where it's going to cause these derivative traders to really take the opposite side and go long. And so I think this chart is perfect. It expresses perfectly the sentiment of the market. And until some of the economic problems that we see worsen or get more persistent than they are now, then I think, we may sit in this trading range of silver, $20 to $30 like you showed.
Yeah, I think it's important to note here too, for people who may be considering waiting to buy physical metal, if silver falls to 19, so that would be roughly a $3 drop from here in the paper price. I wouldn't be surprised at all if the premiums on physical rose by an equal amount, by $3. So I'm not sure you're going to see that much of a discount on physical. Now, the mining stocks, or if you want to speculate in the paper markets, you might see an opportunity here. But
that's such a good point, because we often do see that when there's a spike down in the price, right? When there's a significant drop in the price, we see the premiums rise. Yep. Good right now, we actually haven't seen that in the last day or so. Premiums are about the same as they were yesterday when the price was $1 higher. So that's really good right now. But, when we saw, for example, back in 2020, when we saw that, $11 silver premiums were sky high at that time, right? So ever since then, premiums have been really higher than normal, which is really interesting. So yeah, you don't always get that discount, even though the spot price falls. But if we could then, get a look at the gold chart as well, Steve, if you'd like to share that.
Yeah, I'd be happy to. Let me just pull up that chart real quick before I share the screen.
And a comment while he's pulling up that chart, I suspect, based upon the retail inventories we're seeing at some of the larger brokers, that there is enough silver available to absorb some of that additional demand. So I don't expect premiums to rise quickly. I think we probably got a month or two of extra supply out there. People sold quite a bit over the summer.
Yeah, I agree 100%. So yeah, on gold, this is zoomed out about 2 years. And I've been saying this is kind of the line in the sand, this primary green uptrend line that goes back about 2 years. And I've been saying if this support line fails, there's a very good chance we back test 1675 support. That's the recent low. There's a triple bottom there. You can see a little bit more clearly on the daily chart, which I'll pull up now. So you can see that 1675, very clear support there. I'd say that's kind of like the equivalent of $22 silver. We don't want to see 1675 give away. You can see there's a little bit of support right here at 1750. So there's a chance that today was the worst of it. But I tend to think, put it this way, I wouldn't be surprised at all if we pull back to 1675. And that's the key number to watch. And then on the upside, we want to get back above that 200-day moving average and then make a higher high above 1837. And that would kind of be the first signal that perhaps the worst is behind us, because obviously an uptrend is a series of higher highs and higher lows. So making a new higher high would be the first step towards a technical reversal anyway.
And I know we can't give financial advice on this channel, but Robert, if you wanted to kind of share with the viewers your perspective, do you think like dollar cost averaging in this situation is the best idea if people are interested in, increasing their holdings in precious metals? Or, is now a good time, or kind of wait for lower prices?
I'm the type of investor that once I charted what I thought was going to be the biggest gold and silver move, at least in my lifetime, which I think we're still to have, I buy at all prices. So I bought when gold was at 1900 and people said it's the top. And I said, it's okay. I'm buying the bullion. I'm not trading. And I bought, when gold was down $900, $1,000. Same thing with silver down at $11. I bought a lot. So when you're buying at lower prices, it does lower your overall cost of acquiring the bullion over time, especially if you're a long-term holder like me. If you're somebody that just wants to hold a little bit and it's a small part of your portfolio, I would always wait for these pullbacks. And you'll always get these pullbacks in a bull market. It's normal. It's not abnormal whatsoever. If you chart gold now compared to the 1980 market, it's basically following the exact same pattern. So it's okay to see these pullbacks and use those as buying opportunities. I do think that we're at the beginning of another commodity super cycle, though. I wouldn't wait too long if you want to acquire a sizable amount of metal. If you've decided to acquire a sizable amount and that's something that you would like to do, I would probably do it now, even if it goes back to 1675, because I don't think it's going to stay down for long. Once you get in these commodity super cycles and you see the other commodities start to rise, usually gold will do that. In fact, gold leads investment into the mining space as well. And we need the miners to pull stuff out of the ground because we're running shortages on a lot of critical minerals, barite, silver, copper, lead, zinc, a lot of the common ones, the rare earths. So gold, there needs to be investment into the mining space, and gold always leads that. So when you start to see dollars come into the gold mining space, it's probably a good sign that we've reached sort of that second stage of the commodity bull market. Right now, we're sort of in the stealth phase. Commodities are going up, but people aren't aware. But people will all of a sudden become aware.
You know, Elijah, I think that's such a good question, because a lot of people want to focus on, you know, what's going to happen next week with the metals prices. And I think probably more important than that is having a personalized strategy to handle a variety of different outcomes. So, you know, there's no right or wrong answer, but, you know, decide now. Are you going to dollar cost average? Are you going to scale in on weakness? Or are you going to wait for a technical reversal? All three of those can be correct answers, but, you know, have a plan ahead of time. That's the most important thing.
So good points there. And yeah, I mean, I think one of the things that Andy Schechtman also points out is that, you know, if you already have a core position, yeah, then you can kind of take advantage of those dips. But it's so important to have that core position as insurance to begin with, right? You know, at any price, because you're buying insurance at that point. We have a few viewers' questions here. A few viewers are actually asking about Evergrande. If you've been following that story in China, it's kind of known as maybe the debt crisis with Evergrande, kind of the China's Lehman Brothers, right? So I don't know if, starting with Robert, you have any perspective on that and kind of the crisis we're seeing in China with respect to Evergrande.
Well, I'm going to hold my tongue specifically on Evergrande for now, because I have to do more research. But I will say this, I was reporting as of last year, I thought we saw stress in the Chinese bank market. You had some of their state-owned entities. China government had to go and bail those out. And I thought that stress in those state-owned entities, which are their big corporations that are kind of a combination of commercial and government-owned, they're really government-owned, but they're run as commercial entities. Those started to have major stresses. And I said the banking system is probably coming next, because the bank is what finances those state-owned entities. China bailed out a bunch. And I think now we're starting to see the stress in the Chinese debt system. One of the other factors that's driving stress in the Chinese debt system is the Belt and Road Initiative. China has this massive project designed to connect 73% of the world's GDP economies together across Europe, Asia, sea routes to South America. It's very aggressive, and it's hit some speed bumps along the way. And these are a lot of Chinese loans that are being given out. So I think there are a lot of stressors yet to be seen in the Chinese economy, because China is basically building out infrastructure across the world, not only within China. So we'll see if this metastasizes, you know, and spreads throughout the rest of the China banking system. We're early stages, but again, we saw stresses last year, and it does not surprise me at all that Chinese banking system is starting to have issues. Now, how that affects the global banking system, I think is the big topic there. If China can stop the slide and kind of support it with some you know, positive fiscal programs, they may buy themselves more time. But if they can't stop the slide, it could lead to a domino effect. And this time, it won't just be China that gets in trouble. It won't be a single nation state. It'll be all of them, because they're all intertwined now. They all lend to each other. They all have foreign direct investment in each other's banking system. So we don't necessarily want China to crash, because that means we may be next.
Right.
Definitely. And Steve, do you have any perspective on the Evergrande crisis right now?
Yeah, just like Rob, I'll hold off on comments for now. I've read a couple articles about it, but I haven't done a deep dive. But I guess my initial thoughts are, you know, I like to read Jim Rickards for macroeconomics, and he talks a lot about complex dynamic systems and how that applies to the economy. And he used the analogy of comparing the economy as a complex dynamic system to like a snowpack, where an avalanche could happen at any point. And we're naturally inclined to focus on, you know, what could be the snowflake that causes the avalanche. And rather, we should be focusing on the snowpack, the instability in the system. So is this the snowflake? Maybe, but you know, regardless, the whole snowpack, so to speak, is unstable, and you know, the environment is ripe for a major economic crisis, and it's just a matter of time. You know, are they going to be able to paper this one over or not? Remains to be seen.
I think that's so key, because it seems like ever since 2008, I mean, if you look at how the fiscal policy and the monetary policy has been since then, it's been very different. It's been abnormal. You've seen the Fed balance sheet just skyrocket since then. This is not normal times, and it seems like there has to be a day of reckoning coming sometime soon. And maybe it's, you know, as you mentioned, that snowflake for the avalanche. Maybe we should be focusing a lot more on all that snow right there, not just the snowflake, and being prepared for that. But before we let you go, kind of one last viewer's question I wanted to pose to both of you. I guess we can start with Steve, your perspective on the silver supply right now. This viewer is wanting to know about that? Because we saw, the silver squeeze, and there was concern about the silver supply, and then now premiums on retail product have been coming down. So your perspective on that?
I suspect Rob can speak more intelligently about the inner workings of, supply demand fundamentals. I'm more of a technical analyst, but we know there's the supply demand fundamentals are bullish, and we know that it's industrial demand is increasing. There's not much new supply coming on, but ultimately it's going to be the retail investment that really, I guess you could say, breaks the back of the paper paradigm and really sends price to the levels we're all expecting. So I'd focus on that industrial demand, or retail demand. But no, I don't have any specific numbers to quote.
No, if we could turn to Robert on that question about, do you have any concern about silver supply going forward?
If you allow me to share a screen, I'll show you a nice little chart which gives us a projection.
Definitely.
All right, so we'll do that. This is actually from Discovery Silver, which was a question asked in the chat. I don't know if we'll have time to get to it, but this is a nice little chart which is showing silver supply and demand. And this is from the Silver Institute and BMO Capital Markets. Here's the supply deficit we're expected to see in silver by 2030. So we've already hit the silver cliff. We're going to be in a deficit in 2021 for the first time in a little while. We're actually in deficit prior to, but we had a slight positive amount between what the miners are producing and what we're using in industry. And the Silver Institute predicted just this year that we would produce a little bit less than 1 billion ounces, but we'd use more than 1 billion ounces for the first time, and basically in history. So I do expect, from a physical perspective, there continue to be additional deficits in silver. It's used in the space race. It's used in everything. Our technology economy is based upon silver. And until we find an adequate substitute in all of its myriad properties, you're going to need a lot of silver. And this is not even the investment demand. If we have another Wall Street silver event where people turn to it from a retail perspective, it's going to drain inventories very fast. So I'm just talking about the slow and steady increase in the amount of silver demanded and the deficit it's creating. If we have any sort of banking issue like we talk about with Evergrande, or any sort of recessionary pressures, fall in employment, anything like that, raise in bond rates and interest rates, it's going to cause investment demand in silver to skyrocket, and then it's going to get worse. So you have that normal increase in silver and that deficit, and then you're going to have that potential black swan risk there as well, which I think is where you're going to get the big move in the price of silver. But again, you've got a decoupling from the derivative markets and the physical market. Eventually, as Steve said earlier in the presentation, that's got to give. It has to give. It always has over time in any commodity. It's got to give in silver. This silver shorting down to $22 and possibly $19 cannot last forever. It's literally impossible.
All right,
Elijah, if I can I change my official answer to what Rob said?
Definitely. Fantastic. Well, thank you, Steve and Robert, for joining us today. Before we let you go, I guess starting with Steve, where can our viewers find you online and sign up for your newsletter?
Yeah, we put out a free weekly report. It goes out every Sunday. And you're welcome to sign up for that. You can go to silverchartistreport.com. Actually, you know what? I almost forgot. We created a special link just for your listeners, and that's silverchartistliberty.com, correct?
That is correct.
Silverchartistliberty.com, correct. And that's where you can get the free letter. We do have a low ticket premium service, but there's never any pressure to sign up for that. And I'd encourage you to check that out.
Fantastic. Robert, where can people find you?
Also want to say I've been enjoying Rob's content a lot lately too. I've been just learning a ton from him, and really appreciate getting to speak with him today.
Well, thank you very much. I appreciate that.
Fantastic. And it's goldsilverpros.com. Where else can people find you, Robert?
You just go to goldsilverpros.com. If you want the notices on the free content, just click that newsletter button and put in your email address. Next week, we're going to announce a new subscription product for people that are interested in that, but we'll put that on our channel next week as well.
Fantastic. And if you'd like to sign up for our free newsletter, libertyandfinance.com. Once again, Robert and Stephen, thank you so much for joining us today. And thank you to all the viewers joining us on live stream.